the current dynamic changes, I think that's when we're going to see big moves in the price of gold and silver. And I'll tell you what I'm talking about right now. We're going to get right into it. Do me a favor, put a 1 in the chat if you can hear me, if everything's coming through okay. I just want to make sure before we really dig into this that everybody can hear me on this live stream. And what we're looking at here is a chart of the silver price versus, silver price in orange there, versus the yield on a 10-year treasury note. And this is today's chart. And we're going to come back to this and talk about this dynamic. But first, I want to look at it on kind of a simpler chart here, the silver price. This is the one from SD Bullion. Also happens to be today's video sponsor. Check them out with the link down in the description if you'd like to buy into this slight dip that we're seeing. Now, as you can see, we started off earlier, we had silver above 23 bucks. Thank you, everybody in the chat, by the way. And we had this kind of, not a huge move down, but it was looking like a pretty nice day in the silver chart. And then we got kind of this big move down between 945 or so, and just recently we're kind of ticking back up now. But going back to this chart here, this 10-year yield versus the silver price chart, and you can see a clear relationship here. And again, this is just the daily chart, but we had silver kind of slightly up at the beginning of the session, and then you can see it began to drop just at the same moment that the debt market started to sell off, and we began seeing yields move higher. So first of all, right now, just going to the 10-year yield here, this is a fairly significant move. We're seeing it up over 4.9% today. And again, the yield on a 10-year treasury note hasn't been this high since 2007. So, buckle up is what I have to say when it comes to the debt sell-off. But as yields move up, we're seeing the price of silver come down, and that was kind of what triggered the drop. So if you're wondering why the price kind of suddenly dropped today, that's why. It appears to be that the debt market was selling off. And what happens here is as U.S. Treasuries, the yield moves up, it becomes a more attractive place for folks to park their money. The higher yields go, the less attractive something like silver with, no yield becomes. But I do think we will see a different dynamic emerge here at some point once we reach some kind of a crisis point. I mean, I can't tell you exactly what is going to change this dynamic, but I do believe that there's going to come a day when we see rates continue to move up, but we're going to see gold and silver move along with them, move higher. Because what's going to happen is I believe there's going to come a time when inflation is going to be moving out of control, and that could be a result of current geopolitical events that are taking place in the Middle East that could drive the price of oil much higher. That could drive inflation up. It could simply be that, there's still a lot of money out there that the Fed has created. They've been trying to rein it back in, but as you know, if you've been following the inflation numbers, they're remaining persistently high. We got 2 months in a row, 3.7% year over year inflation according to the CPI. The CPI bottomed out in June, and it's been kind of moving up, trading flat, but it's higher is the point. It's much higher than the Fed's 2% goal. And there will come a time when investors begin to understand that that is going to be the dynamic moving forward, is ultimately much higher inflation. And the higher inflation is going to drive yields up, because as the currency continues to lose value, investors are going to demand higher rates in exchange for putting their money into these U.S. paper debt instruments. The yields will have to keep up with inflation. And I mean, I think that we all know, excuse me, a little drink here. I think we all know that the inflation, the real inflation, is actually much higher than is stated by the CPI. It's probably something like 2 times that, just to get a rough figure. So let's say we're actually at, what is that, 7% interest rates or higher, 7.4% interest rates. That would mean that the yield on U.S. debt is going to need to move much higher, and I expect that that will be the case. I do think we're going to continue to see this sell-off. Now, the Fed, it is still widely anticipated that they are going to pause at their next meeting, even though before all of the current trouble kicked off, Powell was telling us that we had at least one more rate hike before the end of the year. But I think the Fed is scared of inflation running out of control here, and that is why, or rather they are scared of a credit lockup, and that is why they are willing to risk inflation running out of control by not hiking rates. But of course, the thing that really ensures that rates are going to continue moving higher and ultimately that there's going to be much higher inflation is the U.S. debt. Now, this is the most recent data from the Debt to the Penny website. They have Monday's data here. You can see we are now sitting at a total public outstanding debt $33.59 trillion, well on our way to 34. And, with the current events playing out in the Middle East, it's very likely that this is going to move much, much, much higher. And so this means that the supply of U.S. treasuries is going to increase dramatically as the Treasury has to finance all of this debt. I mean, the debt literally is the issue of new treasuries. So that is going to cause rates to move much higher. And when you see a big debt sell-off and you see a big move up in the precious metals, you know that things are about to change. And I think we are getting very close to that point. One reason is that even though the fact that the debt market is selling off today, yeah, silver is correcting, but gold remarkably strong. Now, it did start to come down around the same time, around 9:45, when this big debt sell-off began. But if you look at the longer-term chart of gold, you can see that now we've regained all of the losses from the recent sell-off, and yet the 10-year yield is higher now than it was all throughout this time period. So I think you're beginning to see a little bit of a breakdown of that correlation between higher yields and the precious metals coming down. And in an environment of significant inflation and investors losing their faith in U.S. Treasuries as a safe haven, it makes complete sense that you would begin to see the safe haven bid move over to the precious metals. That is the alternative safe haven. I mean, if the U.S. dollar and U.S. debt is not the safe haven, then what is, right? Well, it's going to be gold and silver. And Lucian in the chat there, exactly, says bonds are great until the dollar crashes. And, what good is a 4% yield or a 5% yield if it's getting paid in worthless currency? I see C130 popping into the chat. Hello, C130, sir. And, really, this is a pretty quick video. I don't have a whole lot more to say about that, except that it's very interesting that that is what is driving this correction in the silver and gold price today. We better keep an eye on that 10-year yield because, that if that continues to move up, this is exactly the sort of thing that could create a systemic crisis in the system. And ultimately, the banks are very vulnerable to this. The U.S. government, one of the biggest debtors of all, very vulnerable to higher rates. The only way that they're going to be able to get these rates down, if they do want to get them down, is by returning to quantitative easing and debt monetization. But you got to understand that that's only something that will work for so long. It's not a magic cure. I mean, it's a terrible monetary policy in the long run anyway, because what ends up happening is the Fed expands its balance sheet, inflation starts to run out of control. I mean, it's exactly the dynamic we're witnessing. They can't normalize things because the whole system risks crashing, and the next time around, they're just going to have to print even more money. And basically, the bottom line is that inflation is going to be moving very high, and I think there could come a point where, without completely sacrificing the dollar, the Fed will simply have to let these rates move up. But again, this is indicative of the no solution position that the Fed finds itself in. I mean, they're damned if they do, damned if they don't. If they try to normalize things and fight inflation, I mean, they're selling assets off of their balance sheet right now. They've gotten down from a peak of just under $9 trillion to around $8 trillion in treasuries on their balance sheet now. But we're already seeing the rate on the 10-year yield in U.S. treasuries across the board spiking up. I mean, look at the 5-year chart here of the 10-year yield. This is a huge move off of the 2020 lows. And remember, this is the only time, I think, since 1787 that you have seen the 10-year yield moving up 3 years in a row. This is a huge problem, and currently it is putting a little bit of pressure on the precious metals. I mean, you can see on a daily basis here, at least, this explains the decline, and it's a pretty clear correlation, by the way, on this chart. I mean, look, you see around 950 or so, 945, silver peaked, and that was when the 10-year yield started to rise. And you can see once the 10-year yield peaked, silver bottomed. So clearly, this is the dynamic that is driving this price action at the moment. But very soon, this is going to be something that changes. And I do think it'll be too late to get your hands on precious metals at that point, at least anywhere near today's prices. Not financial advice, but I am continuing to stack. I mean, a little pullback today, nice opportunity to add some more metal to the stack, if you ask me. I will be stacking whether the price goes up, down, or sideways at this point, because eventually this dynamic is going to change. And I mean, the only thing that's really guaranteed here, folks, is more debt and more borrowing, and ultimately all this debt is going to have to be monetized by the Federal Reserve. 33.59 trillion. We're well on track to hit 34 by the end of the year. And with the way things are going, defense spending alone could drive it up much higher than that. So let me know what you think in the comments down below. Thanks for tuning in, everybody. Stay safe and happy stacking, and I'll catch you next time. Smart Silver Stacker out.